We all know we should save money, but when it comes to actually doing it, most people fall into one of two groups. There's planners and non-planners. Non-planners tend to save when they can, maybe putting a little bit into a retirement plan at work or setting some money aside when they have some extra cash, hoping it'll all eventually work out. Planners, on the other hand, know exactly what they're saving for, how much they need, and how long it'll take to get there. Now, be honest, which one sounds more like you? If you are thinking non planner, you're definitely not alone. According to Schwab's 2021 Modern Wealth Survey, only 33% of Americans have a written financial plan. And when asked why, most people said it's too complicated or they just don't have the time. But here's the thing, a financial plan doesn't have to be overwhelming or time consuming, and it's about so much more than just saving for retirement or investing your money. So in today's video, I'm going to break down exactly what goes into a financial plan, step by step. By the end of the video, you'll have a clear roadmap to start building your own plan, one that's simple, actionable, and fits your life. Let's start with the foundation of any financial plan, setting clear goals. Think about this. What are the top 3 things you'd like to achieve financially? Maybe it's buying a house, paying for your kids' education, or just retiring early. Now ask yourself, when was the last time you really sat down and thought about those goals? Without clear objectives, it's easy to drift and spend money in ways that don't reflect what truly matters to you. Goals give your financial decisions direction and purpose. Every investment you make, every dollar you save, and every spending decision can be tied back to those objectives. For instance, if your goal is to retire comfortably, your savings and investments need to align with that timeline. So here's a simple way to start clarifying your goals. Think about them in terms of form: family, occupation, recreation, and money. What do you want for your family? Are you concerned about taking care of your parents because they're starting to get older, or making sure your kids have a strong financial foundation? For your occupation, are you aiming to retire early, change careers, or reach a certain income level? Then there's recreation, your bucket list items, your passions, your hobbies. What will it take to fund those? And finally, money ties it all together. Whether it's reducing lifetime taxes or creating a written investment plan, your financial goals should support these larger life priorities. So take a moment to think about these areas and write down at least one goal for each. This step will be the cornerstone of your financial plan. Next is your cash flow. Let's take a moment to look at one of the most important numbers in your financial plan, your free cash flow. Do you know how much money you have left at the end of each month after covering your essential expenses? And more importantly, are you using that money with intention? This is a snapshot of how efficiently you're using your money each month. Now, to figure this out, take your total take-home income and subtract your essential expenses. So let's look at an example of this. We have John, who earns $3,400 a month from his job. His essential expenses include everything that keeps his life running smoothly. So this is things like rent or mortgage payments, utilities, internet, phone bill, groceries, gas, and minimum debt payments. These are all the non-negotiables that keep the lights on and food on the table. Now, typically, these essentials should take up about 50 to 60% of your take-home pay. So in John's case, his essential expenses total around $1,700 a month. When you subtract that from his $3,400 income, he's left with $1,700 in free cash flow. This is the extra money John can use however he wants, whether that's saving for a future home, traveling, investing, or paying off student loans. So here's what I recommend. Calculate your own free cash flow for this month. Take your take-home income, subtract your essential expenses, and see what's left over. Then decide where you want that money to go, whether it's saving, investing, or paying off debt. By tracking this number on a consistent basis, you'll have a clear picture of where your money is going, and more importantly, how much you can put toward building the life you want. Next is investments. When it comes to investments, the options can feel endless, right? There's stocks, bonds, real estate, commodities, Bitcoin. Where do you even start? So here's a question to consider. How much risk are you truly comfortable with? Would you be able to sleep at night if your portfolio lost 20% of its value tomorrow? And what about your timeline? Are you investing for a short-term goal like buying a house or something long-term like retirement? Your risk tolerance and time horizon are the 2 most important factors in deciding where to start. If you're young, you have the advantage of time, which means you can take on more risk since your portfolio now has the time to recover from potential losses. But if you're nearing retirement, you'll want to focus on stability and protecting the wealth that you've already built. So to get started, there's a free tool called the Smart Asset Allocation Calculator. It can help you see what a balanced portfolio might look like based on your comfort level with risk. So use this as a guide to start mapping out your own investments. Next, let's talk about debt management. Here's something to think about. Do you know the interest rates on all of your loans? Are you confident in your plan to pay them off? If the answer to either question is no, again, you're not alone. Many people carry debt without a clear strategy for managing it all, but without a plan, that debt can build up, eating away at your ability to save and invest. Now, there are two popular methods for paying off debt. There's the snowball method and the avalanche method. The snowball method focuses on paying off your smallest debt first, giving you quick wins that build momentum. The avalanche method prioritizes debts with the highest interest rates, saving you the most money over time. Both of these approaches work, but it's about finding what motivates you to stick with it. Again, on calculator.net, there's a great tool here for the mortgage payoff calculator. Plug in your loan details, then see how much money and time you could save by making those extra payments. For example, on a $400,000 loan with 25 years remaining, adding just $100 to your monthly mortgage payment could shave 2 years off your loan and save you $35,000 in interest. This is a pretty significant savings by just adding an extra $100 a month to your payment. Now, let's tackle a topic that often feels overwhelming: taxes. Let me ask you, do you feel like you're keeping as much of your income as you should? Or does it feel like you're always giving the IRS a tip? If you're the latter, it might be time to explore ways to optimize your strategy. Maxing out retirement contributions is one of the simplest ways to lower taxable income. Contributions to 401ks or 403bs are pre-tax, which means every dollar you contribute reduces your tax burden for that year. If you have a high deductible health insurance plan through your employer, opening a health savings account can provide additional tax benefits while helping you save for future healthcare needs. You can also consider tax-saving investments. Sometimes saving money on taxes is as easy as choosing the right types of investments. Investments that minimize trading activity and offset gains with losses may result in a lower tax bill. Some investments are exempt from taxation altogether. For example, there's index funds and ETFs, which are popular in this category because they replicate the holdings of an index. They don't trade in and out of securities as often as an active fund would. Constant buying and selling by active fund managers tends to produce taxable gains, and in many cases, short-term gains that are taxed at a higher rate. There's also income from municipal bonds, which are issued by state, city, and local governments, is generally free from federal taxes, and municipal bond income is also usually free from state tax in the state where the bond was issued. You can also deduct capital losses to offset your income up to $3,000 per year. So for example, if I sold this stock in my non-IRA investment account for a $3,500 loss, I can take $3,000 of that as a deduction against my income for the year, and the remaining $500 loss can be carried forward and used in the following year. Now, if you're self-employed or if you own a business, you have even more options because you can deduct work-related business expenses. Now, I'm not going to go through all of them here, but here's a quick snapshot of 20 of them. If you pause the video, you can look them up and talk with a tax advisor. But whatever your situation, the key is to take action. Even small changes like increasing your retirement contributions can make a big difference over time. The next planning topic is retirement. Retirement for many people can feel like a distant goal, but here's a simple question. Do you feel like you're on track? Because for many people, the answer is no. In fact, over half of Americans feel behind on their retirement savings. So to get an idea if you are on track or not, I recommend using, again, another retirement tool on calculator.net. All you do is enter your age, income, savings, and it will show you whether you're on track to meet your retirement goals. So adjust the numbers, like increasing your savings rate or changing your expected retirement age, and see how it impacts your future. Planning for retirement isn't just about hitting a single number. It's about understanding how your spending will change over time. Because in the early years of retirement, you'll likely spend more on travel and hobbies, while later years might bring higher healthcare costs. So take a few minutes to explore this tool and see where you stand. It's a simple way to start making progress. The next planning topic is insurance. There are a variety of different types of insurance out there, but for this section, I'm going to focus on life insurance and disability insurance because, in my opinion, they are the foundation of a financial plan but are often the most neglected. Many brush it off with the "this one happened to me" attitude, and I know this because I used to sell insurance for 7 years. So here's what I learned: you are your most valuable asset. When other people depend on you, your family, kids, employees, you become even more valuable. So, in my opinion, it's your responsibility to make sure those who depend on you are protected if you pass away or become severely disabled. Because if there isn't any protection in place, they can potentially lose everything, and I've seen it happen. You don't buy life or disability insurance with money, you buy it with good health. The younger and healthier you are, the cheaper and easier it is to get insurance. If you wait, not only does it get more expensive, but your options might also be limited. So, if you don't have life or disability insurance, do your research for policies that could potentially fit your needs. Protecting your loved ones isn't just a financial decision, it's a way to give them peace of mind. Finally, let's talk about estate planning. Do you know who your beneficiaries are on your accounts? When was the last time you checked? This might seem minor, but it's so important. I was with a client reviewing her life insurance policies, and turns out she had a divorce 5 years earlier, but forgot to change the beneficiary on her policy from her ex husband to her daughter. So thank God we were able to catch it and change it. Now, here's what's important. She still had a will detailing that everything was to be left to her daughters, but that wouldn't have mattered. Beneficiaries listed on retirement accounts and life insurance policies take the place of whoever is listed in your will. So review your beneficiaries and your will at least every couple years just to make sure your assets go where you want them to go. Each of these topics, goals, investments, debt, taxes, retirement, insurance, and estate planning, they all play a critical role in your financial health. They don't exist in their own little silo on their own. Your financial goals shape your investments influence your retirement plan impacts your insurance needs, and so on. So, I hope you understand that by integrating all these elements into a single cohesive financial plan, it'll help you have a clearer picture of where you're headed and how to get there. So, thank you all for watching, and I will see you in the next one.